Let's get to the markets now. Slipping now in the final hour after one inflation gauge came in a lot hotter than expected in May. The Labor Department reported that the producer price index jumped 6.6% last month. That, by the way, the largest gain since 2010. Another worrying report out today, retail sales dropping 1.3% in May after rising 0.9% in April. Could this be a signal that the economy no longer getting a boost from all that fiscal stimulus? We'll have to wait and see. I want to bring in our traders to talk about it. Greg Swenson and Tom Hayes. Gentlemen, the Fed kicked off its two-day FOMC meeting today as two major economic reports were released. We did see the S&P close at a new record yesterday, by the way. Just has to make any sort of gain today to also post another record. But my question to you two is, what can we expect from the Fed tomorrow, and how will whatever they say impact the overall markets? Greg, let me begin with you.
Yeah, good question, Ashley. And I think the Fed will probably say nothing. At least that's the consensus. They might make a mistake. Powell might make a mistake and let something slip. My guess is he will maintain his extremely dovish stance, and it will just be business as usual from this Fed. And that will be good for the markets in the near term, but I think destructive in the long term.
Tom, is this the last Fed meeting that can deliver that dovish message? Is the writing on the wall, so to speak? And what do you expect from Mr. Powell tomorrow?
Well, Ashley, it may be one of the last few. The Fed has a dual mandate, price stability and maximum sustainable employment. If you look at February of 2020, pre-pandemic, the unemployment rate was 3.5%. It's 5.8%. So they have cover to do a lot more. And particularly, you've seen two things happen. You've seen, except energy, you've seen commodities, lumber, copper, the grains come down. They also have cover to do nothing and be dovish tomorrow because you've had two jobs report misses in the last 2 months. And those jobs report misses are likely to persist through September when the extended unemployment benefits expire. So as a result, we like those groups that have been underperforming this year due to fears of inflation and fears of tightening, which will probably be later than expected, tapering in early 2022, rate rises in probably early 2023. So the groups that have been affected are tech, utilities, staples, and healthcare. For this market to push higher, we're going to need big tech to start to participate, as they're well over 20% of the weight of the S&P 500. And our top couple of picks, Ashley, are Amazon. We like Amazon. Everyone knows the cloud service is growing very fast, 32% year on year. What's lesser known is the fact that their other segment, which is mostly online advertising, grew 77% last year. That's bigger. That makes that business bigger than Twitter, Pinterest, Roku, and Snapchat combined. So we like that. We've got Prime Day coming next week. And we also like the Amazon of China, Alibaba. You can buy it for June 2018 prices today. The difference is the business has doubled. Revenues, earnings, and cash flow per share have all doubled in those 3 years. Double the business, same price. Those are our two deals for a dovish Fed moving forward.
Very good. All right. Greg, what do you say? Do you like some of these big tech names? What do you like in this environment in particular?
Well, Tom made some good points, and I think you want to be long equities that are able to raise prices in an inflationary environment. I mean, there's so much focus on the Fed right now, and I think that's good. But they're actually enabling a lot of this fiscal stimulus from so we can't just focus on the Fed. We have to focus on the reckless fiscal stimulus and spending from the government. So, have to anticipate inflation. I know some of these inflationary numbers are due to short-term issues. I get that, like the supply chain issues and the bottlenecks, as well as the basis of a year ago being very low. But M2's up 26%. You've got reckless spending from the government. And you have naturally inflationary policies like stimulating, even though the economy is in a V-shaped recovery, continuing with this stimulus on the demand side, but while taxing and regulating, which is constricting the supply side. That by nature is inflationary. So is paying people to stay home and not go to work and produce anything. So that's also inflationary. So I'm more concerned with the long-term inflation than near-term.
All right. Gentlemen, we're going to have to leave it there. Greg Swenson, Tom Hayes, thank you both for joining us today. We do appreciate it. All right, on to this issue.